Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast with myself, Gareth Morgan. And in this episode, I am interviewing Max Scott. Max is a businessman. He's been a serial property investor. He's done loads of different types of deals in different strategies and in different countries. He's now investing in Ireland and supported living, which is very topical. And he's also got a book about property, which is imminently about to be released. So he's very much looking now at AI as well. So there's lots of topical conversations, a really exciting conversation. So there's plenty of hints and tips in there. So I would thoroughly encourage you to listen to it all. And enjoy the episode. Max, welcome to the show. Really excited to have you here. Really excited to get into this conversation and share some of your experience, your background and your knowledge, which is obviously pretty in-depth, which we're about to learn. But how are things?
Yeah, very good. Thanks. How are you?
Yeah, I'm pretty good. Obviously, the weather's changing a fair bit and opportunity to get outside. But from a business perspective, there's lots going on our side within the business and some property transactions also ongoing as well. So yeah, exciting times. How are you finding things?
Yeah, very good at the moment. It's an exciting time, I think, in business and in life. I think AI is about to start having a big impact and creating a load of new opportunities and disrupt markets. So it's not mature anymore. There's going to be new opportunities for creation of businesses and ideas and implementing things and getting things more efficient. And the property market's, interesting and there's a lot of opportunity as well.
Yeah, I think, we try and spend as much of our time as we possibly can, looking into AI, how we can use it and get the most out of it. I think it's such a big space. Yeah. You can easily get lost with it and you can go down rabbit holes. And
I've done that.
I try not to. I try and let Mark do that because that's his skill set and he really enjoys it. But it's knowing but when you start kind of scratching the surface and you can see the capabilities and what it can do, it's frightening, but it's also exciting, probably in equal measures. But also I think when you can see it, what it can do, you also start seeing it more and more in the day to day, and you can pick out the people that are using it, and you can, it's interesting though. But and some use it well, and others not so well. So
absolutely.
Yeah. Okay. Well, look, very excited to talk about various things that you've been up to. But for the purpose of our listeners and our audience, do you want to just give us a background as to, what you've been up to, work-wise, business-wise, property-wise, in the past to kind of, and bring us up to where you are today and what you're up to now?
All right, so I never really had many jobs, did many interviews. My first job was in a garden centre. I found it incredibly boring. No one came in the first hour of the day. And I thought my one thing that I'm going to make sure I do in life is not do anything boring and repetitive. And so I've managed to find my way into something where that doesn't apply. So I went to university, did the most generic thing I could think of because I didn't know what I wanted to do. So I did business management, and I started a business, which I think was really good to do in conjunction with a course because it just meant that I had something relevant to apply it to and would think about it differently. So that was just a snoring pillow that I'd made. I discovered one in Australia when I was traveling with my friend who was, a large man, and snoring was a pain in the arse and would ruin a lot of night's sleep. And he got something which was sold as neck pain solution, and it just stopped him snoring like that. So anyway, we picked it apart, rebuilt it, and started that. And then that sort of got to the point where it might have been something as my property journey kicked in. So I left that where it was, but it was really useful background. At university, I met a professional gambler, set up JV with him, effectively teaching other people how to make £1,000 risk-free from betting. And that gave me quite a good insight into risk management and probability, and looking at things differently, I think, to most people. I hear a lot of people talking yes, no, 100%, it will happen, it won't. And I just think every outcome has a probability attached to it, and you kind of need to see things in that way more often. And from there, I went and started working with someone and didn't like the business that I was in within their group, and put all my money into property courses, and then told that owner that I was going to go and do property, and he suggested that I stay and do it with him. They were quite a small business at the time, and over the years grew quite rapidly, at points making eight figures net profits in a year, and it all went into property. So I ended up building them a £120 million property portfolio, primarily in England and Ireland. And we did most property investment strategies, from buy-to-let, blocks of flats, HMO conversions, commercial mixed use, bought a couple of shopping centres and things like that. And then found that I'd created more of a job when I went into, and was passionate about property because of the freedom. And that's what made me remember everything that I learned and all the conversations that I had, and realised that I didn't quite have that, as well as also when you have children, your capacity reduces significantly. And I was underprepared for that, and kind of needed to reduce the noise and the amount that I'd taken on. And so now, kind of through the woods, out the other side of that, they're 4 and nearly 2. And I try and focus on not taking on loads of spinning plates, and not being the operator responsible for delivery in my business and my work, so that I've got a flexible way of having an intense week or a week off, and kind of managing my life like that, which suits my working style. My I love working and achieving and doing stuff. I've got a real itch to move forward, but I also then want to be able to step back and have a couple of weeks off in France, which I'm doing in June, so like 3 weeks off. And creating a business that allows that really is quite important to me now. So I'm looking out here over Hove seafront, and just cheap little office, but I love it, and it's 5-minute walk from home, and that's kind of like how I'm set up now.
Yeah, the similarities between our lives are coming more and more obvious as you speak. But I'm also booking. I booked 3 weeks in France in the summer, so
right, we'll see you on the way.
Yeah, so but I also didn't know what I wanted to do, and went to university and did a business studies degree. I've always worked for myself. I didn't start a business as young as you did, but went through trying to patent something with a rugby player friend of mine. We used to play both of us played hooker, and we were fed up of trying to throw a wet ball in. So we tried to get this, patented a kind of a vest which had a little towel attached to it, which you'd have under your jersey. So you could so you wouldn't relying on people to give you a towel, especially if you're playing away at various bits. So it just going through those processes, makes you think.
Yeah, it teaches you to think, and actually, you learn as much from your failures as anything else. I'm not saying that was or wasn't it. I think I try and do lots of things, and I take them to a point, and then I say, is this something I should move forward with? And I say no the vast majority of times, but I like looking into something, fleshing it out, seeing what it is. And what I really found is, over the years, that sort of work, getting something to the point, decide whether to do it or not, and saying not now or not yet, means that when the right opportunity appears, you can act quite quickly, because your brain's already thought about something very similar, or even that opportunity, and something else clicks, and then you can now make it work because you've got that extra piece of the puzzle. And I think that's what really being an entrepreneur is all about. It's about trying, testing, looking into things, and finding your way.
Yeah, it's problem solving, isn't it? And it's where is this problem big enough to solve? Are there enough people out there, that will want to buy what you have? And that was the one that we came down to. Well, how many hookers are there in rugby? And how many of them are going to run around with this towel under their jersey? That was sizing up the market and the opportunity. And we go, well, it's not really worth the hassle. So I totally understand that. You mentioned something there around gambling. Talk me a little bit about that. That was interesting.
So basically, at university, I was on the Entrepreneur Society, and someone came and give a talk who was a professional gambler, and he said making £1,000 risk-free was, very, very easy. And that sort of caught my ear, really. And he taught me how to do it. And basically, every bookmaker has a free bet to try and get your custom. So you sign up, you bet on an outcome, then on another betting app, you bet against that outcome. And so whatever the result, you've won some money. And then you basically try and get the pricing right to not lose anything. And then you unlock the free bet, apply the same theory and methodology, and then try and, from a 50 quid bet, try and walk away with something like £45 because they have a small margin on stuff. So, and then you just go through all the accounts and do that. And I set up a website to teach people how to do that. And it was, an interesting route in. And then I did some other stuff in professional gambling, where you're actually placing bets and not laying them. And that gave a really good insight to like arbitrage, percentages being in your favor. And, we didn't lay things off and lock in profits. So it took risk. And so you saw wild swings in the performance. And what I think the relevance is there is, if you flip a coin, heads, tails, you expect 50-50 of both. Absolutely. But over one outcome, it's going to be 100% and zero. Over 10, the range can be enormous. Over 1 million, yes, it should be a perfect or more or less 50-50. But you can have things go forward against you, which are a 50-50 chance of happening very easily. And if a string of things go for or against you in a row, you can be in either a superb or a very challenging position. And it just, seeing something that's 50-50 win or lose that many times in a row, you see it's possible. And when you're placing a lot of bets and using a lot of data, it's just kind of, it's really interesting in terms of the outcomes that are possible, basically.
Yeah. And I guess then, you talked a lot there about risk and identifying risks and probabilities and things like that. How has that shaped what the things that you get up to these days?
Well, I think fundamentally people use the wrong language in words very regularly. And so say, I need this. Well, you don't need it, you want it. And I think this deal will be okay, or I don't. Very few people I've heard say, well, I think it's a 95% chance it'll be fine. There's a 3% chance it will, or 70% chance is going to make some good money, 20% chance is going to break even, and a 10% chance we're in a really sticky situation. And what does that really sticky situation look like, and how does those events occur, right? And that is how we should think and appraise everything, especially when there's a time between when we're looking at something now and when it's going to be delivered. I like, infinite monkeys on a typewriter. If there's one goes, type some stuff, goes away again, you're left with some random letters. But if you've got infinity outcomes, infinite monkeys, they will type every word, story, poem, book, song ever written and ever to come. And so you think it's only enough variations in this outcome that will lead to it being not 100% yes. And so that application might be, well, what happens if there's a black swan, Trump invades Iran, oil prices go up, this affects the finance market. There's all sorts of variables that apply to everything we're doing all the time. And to not see things in it will or it won't, but where the likely impact is likely to be. And you can assess these things. And it's not like getting scared off by them, but you do want to understand how much has to go wrong for this to be a problem. And I call it pre-mortem success and failure. So pre-mortem, and then you say it's happened. We're diagnosing post-event, almost stepping into the shoes of where you imagine refinancing after refurbishing and what that position is going to look like. And say, well, actually, we're in that position and it's all gone wrong. And most people would say, well, no, I don't think this deal is going to go wrong. Okay, well, it's not the point. It's gone wrong. Imagine it's gone wrong. Now, how did it go wrong? Okay, well, the project overran, that cost us more in finance. It overran on cost, that cost us more in build. Then the finance market changed and we had to pay an extra 2% on the arrangement fee, and we had to pay this. The rate was higher and the market went down 10% on lettings because something else happened. There's always a scenario where a profit can turn into a break even. What does that look like? And then you look at that and say, I think it's unlikely. And even if it does happen, we're not losing money. Great, go ahead with the deal. So it's just assessing things there's a variety of outcomes way that I think most people, in my experience, don't do.
Absolutely. And I think one of the conversations that we have a lot is, and it's a difficult one because people will come to us and say, is this a good deal? And that's not our decision to make. Now we can guide you on it because, and I say this all the time, is what's a good deal for you is a different deal for me, is a different deal for a different investor, because based on your criteria, what are you looking for from a return perspective? And what's your model? How are you set up? How are you funding the deal? Have you got partners, etc.? What's your long-term goals? But a great example you just share now is someone who buys a property on a bridge. If they'd done that 6 months ago and now they're getting to the point of refinance, if they'd done that 6 months ago, they would have had no idea about what's going on in Iran and the Middle East and the Trump invasion. And therefore, they would have done the assumptions based on the rates 6 months ago. Now, had that those refinances are coming up now, okay, there's a bit coming back into the market, but maybe a month ago, half of all products were pulled. Some lenders had zero products. They just pulled the products all together and they say, we're going to wait and see what happens. And so if you're on an expensive bridge, and you've only got one option to get off that, and that option isn't available now, where is your risk lie and what is your get out of jail card? If it's a straightforward deal and you've got 50 lenders that you could go to and 2 of them pull out of the market, then it's still not that much of a risk. But like you said, the interest rate might have gone up. But as long as you're stress testing your deal, and it works and you're working back, what is the minimum that we need to do, then so be it. You know what that fail position is. And then you're just taking that risk-based approach to it.
Exactly that. And it's where different strategies have different risk profiles as well, and developing new build flats which don't have a good yield and that there's no investment refinance would be terrifying, because that's where you're most likely you're not going to be able to service the debt. And on an HMO or something like that, your cash flow should be strong. You should have a buffer over the finance rate increasing. And, we put in with our investors market crash clauses now. So if there's a market crash at the due point of paying back, then there's a mechanism for how we work through the opportunity together. The protection then goes to them first still, but basically, do you want to fire sell the asset and get your money back and lose some of the interest and capital, or do you want to ride it out? We'll give you all the income from the property and then we'll pay you back when we can, and this is how you're protected. And kind of just, I think, thinking through how it can go wrong, and then particularly with joint venture partners or investors, and then just like covering off, this is how we plan to deal with those circumstances. And you've got a bit of a framework. And I think once you go into something with that, and then there's a problem, then you see that framework's there, it just really helps the conversation. Obviously, we haven't had a market crash since we put in that clause, but it's things like that where I think you can reduce risk.
And I like what you said there. Just because we haven't had a market crash, it's still, you haven't got to experience that for yourself to put that clause in. You can just know that will happen at some point, in which case it's good to have it in there. But really valid point. So tell me then, great to understand a bit about your background and how that's got you to today. What are you doing investing wise now? You mentioned that you just mentioned some new build flats, which I know you're doing some of that. What's your main strategy at the moment?
I have a few different strategies, really. I do a lot in Ireland, and then I do supported living on primarily HMOs, and then new build or conversions on blocks of flats, which is a partnership model for 20-year leases and specialist supported housing. And I have a tendency to explore and enjoy exploring new things. And I'm trying to keep things fairly consolidated into Ireland, and then in the UK, supported living and joint ventures on the 20-year leases.
Okay, so a hot topic at the moment is supported living. So let's talk about that first. Supported living is a bit of an interesting one from our perspective, because supported living can mean so many different things to different people. and especially lenders. So, so that's the challenge that we get. Some of my portfolio is blocks of flats leased on long-term leases to housing associations, which is a form of supported living, and even that provider has 3 different levels of kind of lease or arrangement or support that they would offer to their tenancies depending on where they are in that journey. So yeah, what kind of supported living are you involved with, and what does that look like?
Well, I think the type of supported living, if I said what I look for with it, it's really a 3 to 5 year contract, whereas many of the responsibilities in terms of management, maintenance and repairs goes on to the tenant as possible. And typically that's an internal repairing lease where they're responsible for tenant damage. The landlord pays for the compliance. I try and get the tenant to do the compliance. It's just like easier access, effort, all of that. And then obviously the tenant covers the void, and that's kind of like, that's more of a lease structure that you're looking at, right? And within that lease structure, generally speaking, it covers a range of supported living. And that can be anything from asylum, where you get fairly big providers covering huge areas, down to people, supported living providers looking at domestic abuse or prison leavers, low-level mental health, low-level support needs. There is an enormous range. I think for me, the main classification of supported living is a corporate entity managing the tenants and people that can't go into a letting agency and say, I would like a property for whatever reason. They have an element where the letting agent would have an element of caution when they see and speak to them, and where they have a need. And so within that, I don't really mind what comes within that. Everyone, I think, deserves an opportunity for decent accommodation. And I think supported living, handing over freshly refurbished properties for supported living providers, allows that to happen. So that's how I deem supported living. It's moving away from shared. I do like it on shared. I think it works financially very well. Moving more towards self-contained. And there's also a little bit of a move from councils away from, CICs, community interest companies, which, I set one up 7 years ago. I'm not part of that anymore. And, certain councils can claim back 100% from certain structures and less than 100% from other structures. And if you think about what councils' budgets look like at the moment, none of them are in a particularly healthy position, and it ranges from extremely unhealthy or bankrupt councils through to not very healthy at all, and there's not really a level above that. So there is a direction things will go in, but generally supported living is also people that should get better or move out within a short period of time. And because of that theory, the government decides to give short-term funding, which then means it's quite hard for these charities and entities and housing associations, whatever, to make long-term decisions, and that causes a few challenges in the market in my perspective. But essentially, it's getting a lease on a property with a specialist user, and they carry out, there's no voids, they deal with a lot of the internal maintenance, and there is less or no.
Yeah, and I think one of the main reasons for me that I got into property, and I'm sure we'll talk about this a little bit more in a bit, one of the main reasons for me was I've always been self-employed, like I mentioned, and for me it was about building a pension. And so I'm thinking long term, but I also want passive income. That for me, I was sold the passive income dream, at property training events, as I'm sure you've had as well. And I've done various different types of property, pretty much most of them strategies, some of them a lot less passive than others, such as SA and short-term lets, very hands-on and managing properties. So for me, when I stumbled across long-term leases, really, and when I first heard, I thought, what, really? You're going to just let this off me 5 years and you're going to do all the maintenance? I'm not going to have any voices, no management, no bills. I thought this is the holy grail for me. So I've just tried to continue that as much as possible. And it's not passive, but it's
very
as close.
Yeah.
It's as close as it can be, And I think nothing is truly passive, even if you invest in the stock market or whatever, different funds, there's an element of management, isn't there, and admin involved. So, but it's just as passive it can be.
Certainly setting up front. I mean, I prefer to work hard up front and then have passive. It goes down to that choice of when you work and being able to step away again. But so nothing is really passive unless you have a team to deal with it. And so like, for example, my executive assistant and operations executive and my accountant could make it fully passive for me. I choose to have a tiny bit of involvement, but over the next 6 months, year, I'm sure we could put a decision-making framework in place that meant it truly passive for me. But then if one of those parties left, then you'd have to step back in, etc. And I think what's really interesting about the supported living space, though, is that you basically not only is it more passive and you can focus on the buying side, but your gross rent, becomes more or less your net rent. And if you think about, £1,000 in income, or let's call it £100, and take off 35% on an AST for your maintenance, management and voids, and you're left with 650 versus say 8% for your insurance and maintenance costs on a lease, the difference in net margin, especially over and above the finance hurdle, sometimes you can double or triple your net income. So it is very strong from that perspective. You've obviously got a risk in that if that entity has an issue and you've got lots of lets to that entity, that you might have concentration exposure. Those entities going wrong is rarer, but there is a sort of regulated side of the market and an established side of the market. And then there is I'm going to call it rogue side of the market. And you've got to know what you're going into, really.
And it definitely does happen because client of ours had a 48-bed HMO on a lease to a provider who went bust basically, and that left them in a difficult position. So it does happen.
Like what happens to the tenants? Whose tenants are they? And was that covered off in the lease properly? There's all sorts of things that I don't think that there's a lot of lawyers that aren't experienced enough in it. And the due diligence is, I've known some really experienced and established and known investors, and just the people I've chatted to who've told me they're doing something in the leasing space. I said, that doesn't sound like, can I look into it? And they've not gone through with the deal, and then it's that entity has then had a problem in the future. So you've really got to understand what you're looking at and what you're doing. And I think what really surprises me is lenders. The questions they ask, I'm like, I don't think they understand this at all.
And they don't. And that's the frustrating thing.
And I had one lender say that they did leases. I won't say who for now, but then we put in the structure, they're happy. It got through several parts of the application, and they said, oh, sorry, the lease allows subletting. We don't do subletting. I'm like, so how do you do supported living? Because you've said you do it. And they're like, we're not going to answer that, but we just don't do subletting. I'm like, well, it's the only way it can work, because you have to have a lease in place and they have to sublet to an AST. So if you don't do subletting, you don't do leases. Which is it? And then I don't know whether it's the wrong account manager, or it's the complicated question reached people that it shouldn't have, or they don't have an internal policy, or they don't have an understanding. But it's just, I'm like pulling my hair out. I'm like, I wasted 6 weeks talking to you about this, and we never should have had the first conversation. And it's just bizarre.
We try and do that on a daily basis.
Yeah, it must be infuriating. Brokers must bang their head against a brick wall and awful.
And I'll give you an example so something very similar. So we've gone through this so many times, and the leases, people say, oh, I've got this supported living. The first thing we want to see is, right, let's see a copy of the lease, because that's ultimately the strength of everything. All the lending is going to be around that lease. And we had an example. We were confident that this lender wouldn't do it. The client was adamant because he wanted to go to this lender. So we went to the lender and we said, right, will you do this? Let's see a copy of the lease. They went through the different departments and he said, no, we wouldn't lend on it. And, from our perspective, the client's got to pay money up front. They do the valuation up front. And usually, ultimately, the lease is a legal part of the process. And anyone who's gone through lending before, the legal part of the process comes at the end. So you've got the underwriting of the deal, and then you have obviously the valuation, but the lease is a legal document, and so the underwriters don't tend to get involved with the lease. They'll pass that weight, so you can go through the application process, get the valuation done, and get it offered, and then you go on to the solicitors. Now you've paid a valuation fee, an application fee, and may have to have paid some solicitor's fees to then get to the legal aspect. And then they turn around and say, oh, we can't accept this lease because it's got subletting, for instance. And then the deal falls out the window and you've wasted all that time, but you've also incurred expense. And then we had this client who was saying, well, I've got another broker saying that I can go to this lender, and we've done everything up front. We've sent them the copy of the lease, so we won't lend against that. And then 6 months down the line, I speak to the guy and he said, oh yeah, we got it through. And you're like, with that lender, you're like, how does that make sense? And is it the fact that somebody's just missed it? And if your business model is that you're relying on an application, hoping that it doesn't get picked up, like that just, to me, just makes no sense at all, because are you prepared to take the risk?
Banks don't make much sense at all. I think they need some people like us to sort of like talk to their team. And, I think it's also who does what within the bank. Like, I kind of deem it almost like an internal relationship manager, the first point of contact. Their job is almost like a salesperson to try and get the application in through the door. And then it goes to the next person, and then it goes to the underwriter, and it's a junior underwriter. And you get these questions back and you answer them. And I constantly think I'm 2 weeks away from drawdown on a remortgage, and it can drag on for 4, 5, 6 months, because you think we've answered all the questions now, and then they come up with another question, and then they come up with another question. And it's just like they ping it around. Saying, has anyone else looked at this file, fancy look, see if they can ask another question? And I'm like, just ask everything up front. Or give it up front. Let's do the work once. Then you turn 4-month process into a 1-month process, and you just, rather than constantly going back to the task, you just package everything up and send it at the beginning. And it needs to move in that direction, and it's...
Yeah, look, for us, we try and highlight whenever we go to a lender, we'll say, right, this is the case, all the case details. Here's the potential issues on this case, and I'll just use a random example. The property's next door to a pub, in bold on the thing. Yeah, we're all good with that. Go through it. Are you sure? Yeah. And then you get further down the line. Oh, we can't go ahead. Why? Oh, it's next door to a pub. And you're like, really? And how many times have we got to tell you it's next door to a pub? And why have we now 3 months down the line? It's painful. It's painful.
You almost want like hours that they've wasted yours clock, where they have to reimburse you if they wasted your time. I mean,
it'd be amazing, wouldn't it? It'd be amazing. I like the sound of it.
It's just, they really wind me up. But they're an essential part of what we do, and leverage is the powerful part that amplifies all of our figures. So, yeah.
Okay, so that's interesting. Is there anything? So, obviously, you mentioned 3 to 5 year leases, but also you've mentioned earlier on 20-year leases as well. Is there a sort of preference from your perspective, or is that a specific strategy?
They're entirely different models, to be honest. So there are a lot of similarities, but a lot of differences. And 3 to 5 year leases is probably on that, cash flow, buy, refurbish, add value, let it out, 3 to 5 year lease side of things. The 20-year leases is where you go from supported living to specialist supported housing, and think about it as homes for life for people that, once they have a support need identified, they are going to have that support need forever. And therefore, they need to be placed in an environment where that support can be delivered long term. And so because of that, the government will fund it long term. And that is where the lease can be long term. And if the lease is going to be long term, then from the registered provider's perspective, they want the building to be as new as possible, because they're taking on a long term liability. And because it's long, it goes fully repairing and insuring, which means they're responsible for basically everything other than an inherent defect. So the roof, the windows, the boiler, the electrics, they're responsible for all of it. So that is where your gross rent in its truest form is your net rent. You even buy the insurance and they reimburse you for that cost. So it is the nettest of net rents. And that's where, when you get to that length of lease, it's very rare to have a 20-year lease. In the commercial world now, it's gone to, even if you get a 10-year lease, it's 3 or 5 year rolling breaks, or breaks at 3, 6, whatever. There's breaks throughout the lease. And in this, there isn't. And therefore, you do get that commercial valuation and they're index linked, which means they go up each year with inflation. So from that perspective, it's one of the I think it's the strongest lease you can get in the country on any type of property this. But because of that, they can kind of dictate what they want it to look like. And so it's basically a new build or a conversion, as much new as possible, block of flats, 6 to 10, 6 to 12, occasionally more, occasionally less, but really it's in that remit, primarily 1 beds, sometimes 2 beds, and a care space for, the support provider and the care provider to have a base and provide the support needed to the residents of that accommodation. And so you can get quite decent rents on it. And, some of the ones we've had have been like double the LHA rate and that sort of thing. And there are then variations between which providers you go for and the size requirements, and some charge you quite a lot of money to get that lease in place. You're doing a 20-year lease, there's stamp duty on it. They charge you a fee for putting the lease in place, and then there's 3 months rent free and whatever. It varies by provider. So your kind of cash required tends to be a little bit higher. The finance on the longer leases hasn't been, what I think it should be. I think it should get, more and better finance options for what it is. And the funds are a really key part of this, because there are institutions that like the fact that this is effectively government-backed, secured CPI-linked income and will pay a decent premium for that income. However, at the moment, because of interest rates and, other turbulence in the market, as well as still a bit of a hangover from the collapse of one REIT that was buying a lot of this stock. It's a bit like the dot-com crash. They bought every business with a website rather than, that's Amazon, that's Google, they're going to be good, let's buy them, right? So then when the leases started going wrong because they were the wrong type of leases, and I think there is a rogue element to that industry, you need to be very careful that you're not doing one of those, then a lot of people lost a lot of money by backing the wrong supported living leases. So we try and work with the ones that are considered the gold standard, the best sort of 2 to 3, 4 in the industry. And I think if you've got large amounts of cash or a developer building out blocks of flats, it is a really good strategy to be working on. And then we also just we do a JV basically. So either JV with the developer or the investor, and we get the lease in place, and then we have an upside on if the funds buy in the short-term future, that we get a share in that upside, and there's a bit of an fee for getting the lease in place and whatever. So that's a really interesting model. I think it's good now. I think there's your right circumstances have to apply for it to be to you, but I think within the next year or so, it's going to be one of the best models in the industry, and it's very hard to learn about it. There's no one really, you can't Google it or anything like that. It's taken me a long time of keeping an eye out for it, and then just getting a niche. I think someone knows a bit of that, and just piecing together the information, and now got the experience in delivering them.
Maybe desire to sell a course off the back of it?
Potentially. I kind of get interested by a lot of these things and think, I could do that. I think if I do, I will wait until the funds are buying, because I don't think it's for the mass market until then. And I don't like the idea of just flogging. I'm not going to flog courses to try and make money. If I can do a course that adds a lot of value and it's right for a lot of circumstances, but I wouldn't want anyone to attend or pay me any money that it's not right for. And I think there is, it's right for the cash rich and people that are already developing this type of unit. And I wouldn't go beyond there and saying it's right for people just yet, but I think it will be soon.
Yeah, it'd be interesting to hear and follow how that develops. So awesome. And then you mentioned so just moving on from the supported living stuff, and it's really interesting. So to kind of share your understanding, because like you said, there's so many different understandings of supported living, and there's different pockets within different parts of the country and within different tenant and end user types. And, some work well in those locations, other work well in different locations. And lending becomes an issue with some of them and not so much with others. So absolutely, there's a opportunity out there. And I think we are seeing more and more people switching to supported living in some shape or form. So thanks for that. In regards, you mentioned earlier on as well about investing in Ireland. What are you doing over there?
So I am working with building futures. So Ian and Gareth, people might know who they are, especially through Forthcoming Entrepreneurship, how we know each other. And essentially over there, we're doing heavy refurbishments on blocks of flats, HMO conversions, equivalent of, they don't call them HMOs out there, but effectively for the UK market, that's what it would be. And then commercial to residential conversions. So I really like Ireland for quite a lot of reasons. One, I'm based down south from the coast. So for me to get to Gatwick Airport and into Dublin is quicker than to get up to Birmingham, which I do regularly. So it's really quick and easy times to get there. The stamp duty is a huge advantage. If you look at your upfront costs on property and what stamp duty impacts on your margin and how much value you need to add just to make up for the stamp duty, it's quite extraordinary in the UK. And it's 1% up to £1 million, including for limited company owners out in Ireland. And it's only 2% on any amount over. So it's 10 grand for £1 million purchase. I think it's something like 92 or something in the UK for £1 million purchase. And if you think about that difference, that is an extraordinary hurdle that you've got to do on add value, as well as the fact that I think depending on the area you're in England, it's harder to find opportunities to do a heavy refurbishment and add value these days, especially without conversion of use, right? So C3 to C4 or buy-to-let to HMO or conversion from commercial to residential, and you've kind of got that. But to actually just refurbish what is existing and make money over and above the stamp duty, I think is hard, let alone to do it in a capital city or a popular city. Not many people do that in Brighton or London. And in Dublin, what you've got is, because the crash was so bad, I can be in an extremely nice building on a very nice road in a good part of town, stand outside it and go, there's a derelict building there, and a derelict building there. There's just a lot of rundown property, and there's not that same property's a good thing to go into mindset because of how many people were burnt in the crash there. And so there's a lot less competition. And I think all of that, there's 14,000 rundown derelict properties in Dublin, and there's 33,000 homeless in hotels. And you match those two numbers together and think, well, let's renovate the properties and kind of reduce the housing crisis out there. So there's a lot of opportunity for heavy refurbs, low stamp duty, and really I like diversification. Okay, so you make your money as a specialist, and for me, that's property. You keep it by diversification, that's uncorrelated assets. But then we can also diversify within our industry, and that might be not only exposing yourself to HMOs within the Brighton area or wherever, might be blocks of flats as well, or different areas. So Ireland, you've got a complete different market, different currency, different, it's part of the EU. And they've also, because of their English speaking, they're the only English speaking country that's part of Europe now. And so and they've got a low trading tax rate. So all the tech companies are there. And that's meant that they've got a budget surplus. So the government is saving money every year, and enough that when I wrote my book in summer 2025, their deficit was just over 40% debt to GDP ratio. And now it is something like 32, 33, 34, can't remember. And that's what they've done since I wrote the second version, or I just updated the book. And I think that movement is really extraordinary in this day and age. But also, if you think about if the UK, my worry with the UK at the moment is if it has a crisis, it's kind of used, it's like if I'm at 50% loan to value and I'm a homeowner and then I have a personal crisis and I refinance my house to 75%, it's not the end of the world, right? The UK government is approaching 100% debt to GDP ratio. So it's like they've got no equity anymore is the equivalent of, and our debt servicing cost then becomes higher and higher, and then our risk is higher, so their rate goes higher, so then our interest cost is even higher again. And there's this tipping point that we could be approaching in the UK. And I suppose my point is, I feel like Ireland are much better set to handle a crisis than the UK, not if one appears, when. And therefore, I think it's a great piece of diversification to consider.
Yeah, awesome. Cool. Well, look, I'm conscious of time, but it's great to understand more about the Ireland market. I'm sure people can reach out to you, and we'll get your details and share those with you if they are interested in investing in Ireland, maybe or anything else that you've mentioned so far. Of course, yeah. But I'm conscious you just mentioned about your book there. Let's jump onto that. So what is it, and how did that come about, and what's it all about?
So The book is titled very simply Why Property, and it's about the 5 timeless forces that combine to make property the best performing asset class. It came about because I'd committed to writing a series of articles and had a deadline. I think the next morning I thought, crikey, I haven't written this article yet. I don't want to let them down. What can I write about? And I thought, well, I think there's 4 things that make property great. Wrote about that and then reflected and, next week or so, I thought, actually, I think there's 5. And actually, I don't think anyone else has talked about these 5. And I don't think anyone's talked about them in combination or against other assets. And I think it is the fundamentals. Like, I like boiling things down, a bit like an annoying child going, why? And then eventually you get to the root cause of it, right? So from my perspective, relating to property, and I do compare other asset classes in that, property is the only asset with income, growth, stability, leverage, and compounding. And so, for example, gold doesn't have an income, but it has growth. So it's seen as an inflation hedge, and it behaves differently because it goes up when a lot of other things go down. Stocks and shares, well, they definitely have income and growth. However, looking at income, it's not contractual, so a dividend can be stopped during a hard time. Growth would be typical over time, but it's not directly related to inflation. Whereas in residential property in particular, over the long term, I would have thought, and the research shows that the graph of inflation and the graph of rents, there is a strong correlation. Commercial property, for example, doesn't have such a strong correlation because it depends on what's popular at the time. Office might become more popular, or industrial might become more popular, or retail might go down because of online shopping. So, but the inflation is there. And if you own an asset, that income will go up over time, because the tenant will be able to pay more income because inflation is impacting them and everything to do with it. Then it's very stable. It moves very slowly. And other asset classes tend to be much more volatile. And people last year, when I was talking to them, were like, oh, my shares have gone up this. No one's showing off about what their share portfolio has done in this year. But property's kind of just been a bit boring in the last couple of years. It hasn't really moved much. And I think its illiquidity is its weakness, but also its hidden strength. So you can't say, oh, I think everything's going to go wrong. Panic, hit sell. At the very quickest level, you've got to prepare the information to sell it, put it in auction and sell it. And that will take 10 weeks if you time everything pretty well. So you think, well, I can afford to carry on paying my mortgage because I've got income, so I'll ride it out, because no one really likes selling for anything less than its peak. So when something's been valued at 100 grand and now it's worth 90, I think, I'll wait till it's worth 100 again, or 105. And they know that at some point it's going to be worth that. So its illiquidity and its weakness becomes its strength, and an extra reason why things stay stable, because then there's less goes on the market because no one wants to sell during the bad time. So there's less available to buy, which means those that do need to move house, the supply and demand ratio just sort of naturally rebalances, let alone that we're underbuilding houses by however many 100,000 a year forever, and all of that impacting the supply and demand. And our country's one that is going to have population growth through net migration and the impact and pressures there. And then you can leverage the share portfolio, but I don't know how to. And most people I know who are got 6 figures or whatever in shares, they don't leverage their share portfolio, and it's a lower loan to value, and you can get margin called, and it's a completely different risk profile. Whereas because of property stability, most lenders will go, yeah, I'll lend 75% on that. You've got income, and I can service the debt. So that enables leverage in property to be done easily, which amplifies the net result of your income and your growth. So the Bank of England inflation target being at 2% on 100 grand property should mean year on year as an average, not each and every year, but as an average over time, could go up 2%. Well, that's 2 grand over your 100 grand investment. So, nice little extra, because that's on top of your income. You have leverage, and therefore a 25% deposit and a 75% mortgage, and that's 8% on your 25% deposit. Well, if that's what you're going to do, let's say you say, I'm boring, I'm not going to do some sexy strategy, I just want to park my money, and you buy something that is cash neutral, no cash flow, but it doesn't cost you anything, and you buy it with a mortgage, Well, over time, that should go up 8% each year. Well, that's if you do nothing exciting in basics. Well, 8%, a lot of people think, I'd love 8% of my money. And if you go for a non-cash flowing property and leverage it, that's kind of where you should be at over a long period of time. And so nothing really competes with that in terms of numbers. And then when you add that to actually, okay, now I'm going to do an HMO that's going to cash flow and I've mortgaged it, you've got the income is then amplified, the growth is then amplified, stability locks it in, leverage amplifies it, and then that increases those figures, and then you compound a higher number. And when you compound a higher number, the impact is extraordinary. 5% compounded over 10 years versus 10% compounded over 10 years is not double the difference. I haven't saved that example ready for this podcast. So it's something like 3, 4, 5, 6, whatever it is, it's an enormous amount extra that you get from compounding a higher number than a normal number. And therefore I say that compounding is only really in property. It actually technically is in anything that has a growth or an income. So if gold went up 1%, then the next year it went up 1%, you would still have compounding of 1% over 1%. It's not an exciting level of compounding, and therefore I call it meaningful compounding. And that really only applies to property. And it's the fundamentals. There's no strategy. There's nothing, this is what you should do to be successful in property. It's just a short book. I think for existing property investors, you should say to yourself afterwards, I'm glad I'm in property. And if you want to get into property, it should emphasize that that's a good choice. And if you're an entrepreneur or a business owner and you've got a range of investments and not one in property, then you should probably consider getting into that asset class as well.
Yeah, absolutely. I think it's a really interesting topic. Like you said, I don't think I've seen, various people will have written about various aspects of it, and a lot more of the property books out there are more to do with strategy and different strategies on how to get invest in property as to why. They might cover off that why at the beginning, but it's just, going into good detail. And I think you've knocked the nail on the head for all of those for me, and I totally get it. And I'm sure you have done this a number of times, but one of my favorite pastimes when I have 5 minutes is playing around with a compounding calculator.
Yeah, that will always get you excited doing that, won't it?
And if you ever, and as you say, property is inherently boring, and therefore playing around with the most excitement that you will get from property investment is playing around with a compounding calculator. Yeah.
So go on then. If I gave you 1 penny and I let you compound it for 38 days, how exciting do you think that financial result would be?
One of the first property meetings I ever went to, PIN meetings, years and years ago. And obviously Rich Dad Poor Dad is one of those books that gets mentioned all the time, but there was another book mentioned, which is called The Slight Edge by Jeff Olson. I don't know if you know it. And that was one of the first kind of self-help, self-development books that I read. And I think it was chapter 3 in there was around the penny doubling over time. But that was over a month, I think it was. And, I think that was hitting about 10 million or something by the end of it. And it's phenomenal. And that was like a big aha moment for me. You're going, all right, okay. And that's when my journey started in investing. Although I was interested before that. That was like some of these things between that book and Rich Dad Poor Dad really started driving the desire in me to get into property. So compounding is crazy, isn't it?
That's exactly why I got into property. My mum bought me Rich Dad Poor Dad. I read it when I was quite young. And then I saw a little advert pop up for a Rich Dad Poor Dad property seminar. Thought I was going to meet Robert Kiyosaki, didn't realise how big he was. And of course he had a sort of team there or whatever. And it was a funnel into another property training academy. But because I read Rich Dad Poor Dad, I saw that advert. And if I hadn't have read it and I hadn't seen that advert, I don't know if I'd ever gone into property, So that was a key part of the journey as well.
Yeah, awesome. Okay, cool. Well, look, like I said, conscious time, we could probably talk on and on about various other bits. You mentioned AI as well a little bit earlier on. What kind of maybe just a couple of hints and tips or things that you're doing with AI that listeners, if they're not getting involved with, that they may want to look at and get involved with?
Yeah, cool. So I think AI has become really exciting for me in the last couple of months, sort of since the end of January, end of February, something like that, is when I've really got into it more than I had before that. So I always, used ChatGPT and found that really helpful, ideas, research, whatever it is, sounding board. And then I think really things have accelerated for me recently using Claude, and the standard to which it can produce a document. ChatGPT is very obvious that it's AI written, and Claude can do something that's extraordinary with table of contents and structured information. And the more it knows about you and other samples of good work you've done, the more it will find that relevant. And it's got APIs into other tools you use. So you can connect Claude to Asana. I connect it to Fireflies, which is how we have our meetings and those transcripts. And then you can connect it to Microsoft or Google. And so I can point it to a folder, get it to learn about everything in that folder. So for example, the specialist supported housing folder or whatever, and then pick up transcripts and say, I've just met this person, this background on that document, do a proposal tailored to them, and it can just do it. And what I've really done is I've started going from, I want to do a task, to I'm going to build a blueprint, then layer over my information over that blueprint. And that's now that task done for me. And that takes me quicker than it used to do that task. It's done to a better standard. It looks better. It's easier to understand. And then it's scalable and repeatable within my team. So that's my own sort of personal journey. And I would advise people to, look at Claude and connect it to, Fireflies, I think is the only audio transcript it works with at the moment, SharePoint, whatever system you use. And I think that will get you some great results. And I've used it to build, because I had all the standard operating procedures, etc., for leasing and how I found lease providers. I've now got a tool that works in my Claude for finding lease providers. And now I'm just looking at building that into an external app that's functioning for people at the moment. So I don't know how long that will take. I haven't answered those questions yet. And I am going to build an AI platform as well. And I think I'll be able to give more information on that soon. But things have become extraordinarily easy to do quite good work quite quickly now. So I'd say with property, I've condensed what I was doing in, call it 4.5 days a week into one now, because of AI and the efficiencies and how quickly I'm able to produce good work. You do need to check it. It's got plenty of flaws and glitches and hallucinations and all that stuff. So you need to really work with it, give it context and check it thoroughly. But I think I'm convinced that the impact is going to be very imminent and very significant, and will increase productivity fundamentally for everyone. And I think that's going to be a good thing. Increasing productivity is normally what drives GDP forward. There will be job loss risk, of course. And I think my hope is that the government finds a way of taxing the right people the right amount and redistributes it, whether it's universal basic income or whatever, to the people that have lost their jobs. And then I hope the people that have lost their jobs innovate and unemployment goes back down and we go into a great new world. But the variation of how this all looks is quite high, I think. And but it's a really exciting time. I remember going into business and thinking, the internet has existed for ages now. And if I go to find a domain name, every domain name related to that is taken. And you've got to really go with some long domain names or a lot of dashes in it to find something that you can launch a business with. And I thought everything was mature and hard to find an edge and niche. And that's not necessarily the case now, but I think with AI, it's going to completely disrupt that. And so I've always been a fan, for example, of tracker funds and just investing in the stock market with low fees, and that Warren Buffett says that beats hedge fund managers and does his bets or whatever. And I'm now a bit terrified of having a index tracker fund, because I think companies are just going to completely be redundant overnight. They've been established for 10, 20, 50 years by a new AI company that does something much better, much quicker and much cheaper. And yes, I think it's going to be a fast changing world. And I think if you're at the forefront of that, great. I think if you're an entrepreneur, it's going to be the most exciting opportunity of all, because we're the ones with ideas, problem solving mindset. And I think that's where it's really going to come into its own.
I think a couple of points from what you said. One is around the index tracker funds. So actually similar mindset, I've invested, in my ISAs and pensions or whatever into tracker funds, and based on some of that advice, right? Just invest and crack on. I think I read something the other day that the issue now is that so many people with the rise of social media and the same, people, influencers sharing this kind of information as well, that so many people now have gone to those index trackers that it's also become like its own self-fulfilling kind of prophecy, where because so much money is flowing into those trackers and buying the shares of those companies, that they've just become so big they can't come out of there, if that makes sense. Because it'd be interesting to see, and we know that some of these big tech companies have invested in each other and are just adding prices to their own balance sheets. It's all quite of interesting. And is that a pack of cards that could come crashing down? It is interesting. So it is watch this space for sure.
Definitely. But I think it's exciting. And I think you've got to balance looking into it and getting familiar with it now, whilst also, I've been hell for leather in this for months and like just stayed up all night, excited, learning, playing around, doing stuff. And I've scratched the surface. So I would never call myself an expert in anything really, but in AI, I'm not sure any experts exist, because I think they might be an expert, but there's loads that they don't know. And, I said at the beginning, like, even if they do know something, they go on holiday and then the world will change by the time they come back. So, but I think it's important to start understanding it and start implementing.
Yeah, and again, it's the age-old thing, like you mentioned about from an entrepreneur's perspective. You'll have the glass half full and the glass half empty people, and the people are going, "Oh my God, they're going to take all our jobs, and this is going to be this, that, and the other." Are the ones that'll get left behind, and the ones that think, "God, this is exciting, and where can this take us? Or how can I use this? How can I adopt it? How can we improve and iterate and build something and provide a better service?" Then those are the ones that are going to win with it at the end of the day.
Exactly. You don't want to be a London taxi driver that refuses to acknowledge that Uber is coming. And I think that's an analogy that is very relevant. And one of my best friends he just refuses to use any of it because he doesn't like the concept that the world is going in that direction. And I just didn't know whether to be harsh or not. But like, my view is that life could be very tough for him in a few years if he doesn't adapt. He could be at the bottom of the pile. And I think that's worrying for me. But,
Absolutely. So to wrap up then, I guess, any from an investor experience, whether that's finance or just general property investing, why you get into property, we're very clear on why you do that. Any sort of hints and tips for our listeners as to what they can do to get ahead of the curve or things to watch out for?
I think it depends on their background, starting magician, goals and objectives, and I'm hoping that I'll have it built in time is something that helps with that, following on from the book. I think this is a time of great opportunity but also enhanced risk levels. So I think you want to have liquidity, your own money, and you'll make more money if everything's invested and leveraged to the hilt. But you also have more chance of it going wrong. And I think you need to be more mindful of exits and in valuations not coming out where you think and finance increasing. But actually, I think it is going to get better from where we are quite quickly. And I think there's great opportunities to make the most of now. So I think you've got to go into it it's not a time to stop, it's a time to carry on. And that it's probably, the right conditions for making good amounts of money in property. But make sure you can survive some wobbles, basically.
Yeah. What I really liked about what you said earlier on is around the due diligence side of things, and how do you put a percentage on the various outcomes that could happen, and what does that look like, and treat it as things have gone horribly wrong. Why and what could we have done about that, and build, start with the end in mind and work backwards. If it all goes well, great. But what happens if it does go wrong, and what can we put in place? And so many people rely on learning from their own mistakes, when there are so many people out there with experience who've made mistakes. You can learn from them. And, a lot of what we do is kind of risk checking and risk analyzing, and some people will take our advice and other people will say no and completely ignore it, and that's fine. But we want to work with people who, you've got to be sensible, but there is also a risk that you have to take some risk, and if you don't take any risk, then you won't do any deals, and that's a risk in itself, isn't it? So it's getting that balance right.
Absolutely, yeah. I mean, I'll give you an example, right? Going back to the gambling stuff, is that because people knew I was into gambling, people would often say, I'm going to the races, any tips today, right? No one has ever asked me what price those tips should be at. They want to know what horse, they think they should bet on. Well, the best value horse is the one that is the price relative to its outcome. So it might be a 50-1 shot that you want to bet on because it's actually should be 40-1, and therefore you've got a 25% margin, whatever it is. Equally, a donkey that's got no chance of winning the race might actually cross the finish line first, 1 in a billion chance. So put 1 penny on that price. Like, everything has its chance of an outcome, and therefore, it's that you want to try and look at, not what's going to happen. It's like, what's the chance of each thing happening?
Yeah, amazing. All right. Well, listen, Max, thanks very much for your time. Really, really enjoyed the conversation. All the best with the book launch. When is the book coming out?
Towards the end of May. So be pre-orders within a couple of weeks from now. So, yeah.
Amazing. Well, good luck with it. I wish you all the best with it, and all the best with the rest of your investing journey. Good luck with the rest of the year, and it'll be interesting to follow and see what you do on the AI side. So keep in touch, and we'll see you again soon.
Very good. Thank you very much.
Thanks for listening to the latest episode of the Prime Property Finance podcast, and that was with myself and Max Scott, and hopefully you took some real value out of that. There was some really interesting conversations. I'm really excited to get a copy of his book on why property, and as he mentioned, just a quick recap, the fundamentals of property compared to any other asset classes, around income, capital growth, stability, leverage, and overall compounding. So really excited to get my hands on that. And, he didn't mention at the end around the ways to contact him, but if there was anything you wanted to discuss with him about his book, about supported living, about investing in Ireland, or anything else that we discussed, also maybe around the AI, then his details are in the show notes and on how to contact him, and reach out to him and go from there. So thanks very much for listening. If that was of interest to you think it might be of interest to friends, families, or any colleagues or contacts within the property space, then please share it with them. Please like and subscribe to the podcast. It really helps us. And thanks for your continued support, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.